Welcome to Are You Killing It, the podcast powered by Peak Performance Partners, where our mission is to help your business achieve success faster. I'm your host, Dr. John Ronaldo, and each week our team of business experts brings you the tools, insights, and strategies you need to kill it in your business. No fluff. Seriously, no fluff in this conversation, guys. Just real talk to fuel your growth and even our growth, because we're learning here in the process as well. So, guys, let's dive in. Welcome back to another episode. How are you?
We're doing great. Let's
My
go.
account is overdrawn.
Your account is overdrawn. Well, I told you not to buy that expensive car.
Yeah,
I know,
right?
right?
Yeah,
He went
with-
and got a McLaren.
With Peak Performance Partners logos all over it, right? with Lamborghini, was it? So,
Let's
go.
You got the Lambo?
or was that just an AI image?
Yes, that was an AI image.
Oh, well, I am, as always, joined here by the founders and owners of Peak Performance Partners. I've got Kevin Hernandez,
Yeah, yes.
Ricky Navarre,
Hey-o.
and Patrick Stewart.
Good afternoon, morning, night,
What,
day.
what is this from the Truman Show with Jim Carrey, right?
Yeah.
Good morning.
I love that.
And if I don't see you, good afternoon, good evening, and good night. All right, well, there it is, because we don't know when you're listening to this episode. It is afternoon for us while we're recording, but you all don't really care about that. So let's delve into the topic today. We promised last week we were going to talk about this, and here we are. Budgeting basics, money, building a financial plan that works. Last week's episode, we were talking about one of the major blind spots that a lot of businesses have is financial. And so we wanted to kind of delve in a little bit more. There's probably a ton of episodes we can do on finances and budgeting, but we're going to get ourselves started with this one. Budgeting basics, building a financial plan that works. So should I just start with Patrick? Patrick, why do so many small business owners and leaders struggle with budgeting?
I think because number one, they don't know where to start. They have a tough time. Like, even where do I start? How do I guess what my revenues are going to be in December of next year when it's October of 2025, and I need to build my budget for. You're going to tell me I have no idea where I'm going to be. So I don't know how to start.
Right. So
I'm going to
you're
push
guessing,
back a
right?
little bit on that one. They do know how to start. They go to their bank account.
Yeah.
Which, if I read into your comment, you're suggesting maybe that's not the best place to start.
Correct.
Okay. So why is that not the best place to start there, Kevin?
Because again, if you're running your business by your bank account, you're gonna fail fast, right? If you're not making decisions based on financials and correct financials, anybody can put anything into a system, but it's got to be correct, right, Ricky?
Oh, bro, you nailed it when it comes to financials. Correct financials, because a lot of people, when they start their organization, they guess at the chart of accounts. I have to go through the exercise of setting up QuickBooks because I know I need to use QuickBooks or whatever software program they're using, or an Excel spreadsheet, right? But they're guessing at what they should put in where. They don't know where it goes. They have no idea.
Perfect.
And then garbage in, garbage out. So they're like, hey, somebody's like, so do you have numbers? Yeah, I have numbers. Duh. Don't you look at those numbers? Yeah, on a regular. Are they accurate? Oh, I don't know about that.
Well, it's true. I was working with an organization where we were going through an audit, and we had to go back through the previous year's financials and move around where they were put in the chart of accounts, because they were put in the wrong place. Because at one point we gave a annual report to one of the division heads, and they're like, I didn't spend that money. And they looked at the receipts like, that wasn't for my division, that was for their division, right? And that was happening all over the organization. So we literally had to go back through in the audit process and go like, okay, what are the real numbers? Because, this particular VP, she wasn't able to come up with accurate numbers for her budget for the next year because she was given crappy numbers to begin with from last year. And so then we had to go through this whole issue, and the board got involved, and it was really a convoluted, difficult process. But we had a hard time budgeting for the new year because we just didn't know our numbers. Back to your point, Patrick. Like, how can we predict the future when we don't even know what the past looked like?
Correct.
Yeah.
Correct.
So what are some things, that we need to do to kind of fix that, right? What are some steps to take, hey, I know our numbers are not good. They're not in the right place. Chart of accounts are a little bit off. What are some first steps that we need to consider to kind of help get our books in order? Because that seems to be the first step.
Yeah, I think the first thing you got to review it. you got to actually review your financial statement, and then dive into it. Find out, hey, why is this says, $10,000. Why does it say $10,000? Is that a true expense that's in the right place? And so then as you start to review it on a regular basis, then you'll start to see, okay, making sure you're identifying, hey, are things getting put in the right place? Because what you have is you've got fixed costs, right? We got our rents. If you got, some vehicles, you got some, labor's kind of somewhat fixed usually. And then you got your variable cost of goods sold. So if you're in construction, you've got, your product cost, or if you're in manufacturing. So you want to separate those two so that you can start to look and analyze, hey, what is your cost of goods sold versus your fixed costs? Because your fixed costs are going to be there no matter what. So then you got to look at your revenues. And this is how kind of like, as we're starting to talk about this framework of building your budget, right? You got your revenues, your income, and then you've got your cost of goods sold, what it costs to generate that if there's a direct product that's cost. And then you've got your other cost. And so if you just kind of break it up into those three things, and then the fourth obviously is your profit and loss, you kind of get a pretty good idea. And there's a great book called Simple Numbers that kind of shows that. If I would say a lot of early business owners go and read that. That's a good read. And then you can start to create that framework of for your financial setup.
I think the fixed cost versus variable cost, I think is really key. I think a lot of people would love all their numbers to be fixed. And I think that's sometimes how we operate, right? It's just like, can't this month's budget be $1 million and next month and the following month, and just keep it simple that way. But if you're paying attention to your past and the ebb and flow of your business, you're going to understand that July, because XYZ is happening, you're going to have higher expenses in July, and you're going to have more revenue in September because of those higher expenses in July. But
Yeah.
that's kind of normal. How do you get people out of the mindset of kind of everything is going to be fixed cost? Because I would say for me, that feels like a stumbling point for folks. It certainly is for me.
Again, I think it just goes back to that financial literacy. So once you start to look at your financials and have a monthly meeting where you're having a financial meeting with your bookkeeper or with your partners, then then I would say you start to bring in your department heads who have, when they have some ability to move those numbers, right? Either generating revenue or watching expenses. Then there starts to be some accountability to those numbers. But it just goes back to everything. What gets measured gets done. Don't expect what you don't inspect. So we do that a lot in our business as we're managing our day-to-day operations. But for whatever reason, we're not comfortable with the financials. So then we turn a blind eye to it, and we go back to the bank account, like Kevin.
Yeah. So I want to add to that. I think that as a business owner, there's two ways you can set up your accounting. It's either cash or accrual. So if you're a service person and you're going out and you're collecting cash all the time, cash accounting may work for you. It may be good because if you're not taking any payments or you're not billing out any invoices, then you don't have to worry about setting up accrual accounting, right?
Yeah.
And very few businesses really take in truly just cash all the time. So again, when I made that reference, running my business by my bank account, it means that people are looking at their bank account to run their business, and they're set up cash wise in their QuickBooks and don't really truly understand accrual accounting.
So where's the best place to begin, right? So I'm a business owner, I'm a department head. I know my numbers off, or I don't really know my numbers. What's the first step to building a realistic and effective budget?
Call Peak Performance Partners.
No. I would say this, in
We're gonna
QuickBooks,
triage
most business owners have QuickBooks. QuickBooks actually has a simple tool where it will take your past performance and it'll actually just take that out and create a budget for the next fiscal year. And that's kind of something that we did early on. I remember the first time we did a budget, we spent a bunch of time in November, and we said, okay, here's our budget. And then we never looked at it for the rest of the next year.
Right.
And I actually just asked another business owner I'm working with, and I asked her, have you ever done it? She goes, yeah. And I go, do you do you do it? She goes, yeah, I do it every year. And I go, now do you look at it periodically through the year? And she's like, nope. So I laughed. So I go, okay, well, we're going to change that. But then what we did is we started changing that, and we actually started doing our budget quarterly, just so that we could really look at it. And the main reason is that we can keep an eye on our expenses, and that we can, when we say, hey, do we want to spend this money, we can actually say to each other, that's not in the budget. So it helps us save money and that money we save goes right to the bottom line, which eventually gets to our pocket.
There you go. I was part of an organization one time that, we didn't know the numbers at all. And I was the department head. And so I had a whole cost center, but I wasn't allowed to see the numbers for some peculiar reason. I know, Ricky's giving me a look, and I'm just like, I don't understand it, but it is what it is. And then all of a sudden there was a transition, and then I was being asked to come up with numbers, especially on the expense side, but also on the revenue side. And I was like, I don't know if I could provide that for you because I haven't seen the numbers. Yeah. And then when I did finally see the numbers, they were they were accounted wrong and put in the wrong cost center or whatnot. And so how can we use the budget, just kind of piggybacking on that, how can we use the budget as a communication tool as opposed to just a spreadsheet that's sitting out there?
Oh, that's all you, bud.
Oh, you're all right. I was just giving Ricky a chance.
We did before Patrick responds. One of the things that we were joking about when we were prepping for this episode, one of the things that both Ricky and Kevin said, like, "Oh, we're just gonna let Patrick share. This is Patrick's topic." But this is the beauty of being part of a team. You have folks who have different expertise, and not that Kevin and Ricky can't talk budget, but Patrick pretty damn good at it. So I'll turn it to you.
Yeah. Again, I think once you start to hold your team accountable to numbers, and so one of the things, the fears of business owners is they don't want people to know how much money, they don't want their employees to know how much money they're making. Well, what they've done is they've done some studies about that. And one of the things that they found is this, that the business, all the employees, if you don't tell them what the numbers are, and that's called open book management, opening the books up to the employees, they make an assumption of how much you're making. And what they found is the assumption is 3 times of what you're already making, that you're really making. So they think you're making $1 million in sales, that you got $1 million in the bank, or you got 300,000 in the bank, when the reality is you got 10,000 in the bank. Mm-hmm. And so what happens, and that's where that open book management, but as you start to get your supervisor or your department leads, I would say, creating their budget and involved in that process of developing what revenues are you expecting to bring in, what is that going to cost you to bring in, and then here's all of our fixed costs that we got to pay from that money that's left over, and here's what the bottom line is. So then now all of a sudden then you start to review that. Now you've got some accountability to the numbers.
So let's delve in a little bit deeper here. So let's focus on the revenue side. So when we're budgeting revenue, sometimes expenses are easier to project than revenue.
Yeah.
Right. And so, how can I, as a business leader, as an owner, accurately project? Obviously, I can look at year over year data and see, data. Hey, July last year brought in this much revenue, so maybe I'll increase that 5% or 2%. But I feel like sometimes, and I've done this before, I feel like I'm just guessing.
Yeah.
So how do I project well on the revenue side?
And I think that's one of the reasons why we went to the quarterly adjustments of truly it's mostly revenue, because our expenses for the most part are fixed. But I think one of the things that you want to make some kind of estimation of what you're going to do on the revenue side, because that revenue typically is going to be driven from some type of activity, right? Whether it's number of discoveries, sales meetings, proposals sent out,
marketing plan, right?
Yeah, marketing that's driving some leads,
advertising.
Yeah, or the phone to ring. So all of those and all of that cycle of how revenues are generated, you need to be able to keep your eye on it, because you're going to identify areas that you can take advantage of, or places where you're spending money that you're not getting results to either the top line or bottom line.
Yeah, and to that point, I want to add, understanding your financials. So we have a client that basically had monies in accounts receivable that was unaccountable for, right? And it was a nice little sum of money, but just not having that person that understands the AR part of your finances and the structure can cause you some real grief and cause gaps in your cash flow.
And what he was talking about, it was a banking error. It wasn't an error made by anybody else. It was the bank, and believe it or not, banks make errors. It was a banking error on a deposit that didn't get recognized, and it didn't get reconciled, and the
bank added a zero, and
they didn't add. They added zero.
Oh. That's rough, right?
Yeah.
All
and,
zeros.
And how long did it take to figure
Yeah,
that
it was
out?
45 days.
Yeah,
45
longer
days.
than 45 days.
That's
Without that money in the
substantial,
bank account?
right? Yeah, absolutely.
I want to add on, tack on something that Patrick said that, hey, when you're creating your budget, you say, hey, how much are you planning on bringing in? And I love what he said. And what is it going to cost you to bring it in? And very, very few people look at what it costs to generate that revenue. Yeah, we talk about fixed costs, right? Hard costs of rent or the mortgage or in electricity and internet right. But sometimes we forget about the other ancillary things of, hey, what is it going to really cost you to drive that budget? And that's where you can actually start to project and figure out. And then back we said, after you look at it and you set that, then you review it quarterly, really, monthly, quarterly. But then you can adjust the budgets. Just because you set it in the beginning of the year doesn't mean it can't be adjusted. And when you're guessing, because you're hoping for the best case scenario, right, based on past data, and here's where you want, and say, I want to grow 10% or 20% or 50%, or, I want to grow 1,000%. Great, pick a number, throw it, right? And then go get it. But then it's about saying, hey, how do we adjust? And if things aren't matching up, then you pull back.
Yeah, you make
right?
some cuts.
You make some, and that's where sometimes you've got these large organizations who you say, man, they just had to lay off. They laid off hundreds of people. Well, because they were looking at the budget, right? They didn't do it because they were.
It wasn't because of AI. It was because of the budget.
It was the
Okay,
budget.
just make sure.
Yeah, right. Maybe AI affects the
Maybe.
budget.
Well, and I've certainly done that with like nonprofits, because one of the things from a fundraising perspective, I've worked with them. It's like it costs money to put on events. So we may have this kind of big old signature fundraising event, but what we don't take into account is we take the fixed costs, right? The marketing, the food, the drinks, whatever. What we don't take into cost is the personnel power, right? And every human being has an hourly rate, and even the volunteers technically, as they're volunteering, that's a value add to the organization, but there's a cost to that. And in fundraising land, for instance, it's actually cheaper to do a mailing, and you could raise a certain amount of money in mailing than it would to be able to put on an event. Now, there's reason for events. I'm not saying don't do events, but there's math there that's not happening, right? We take the fixed cost. Here's what it costs to buy all these things, but we don't think about the people hours that needs to be taken into account when creating that revenue, whether it's nonprofit or for-profit as well. If we need to take that into account. At what point, we may have talked about this before, but I think it's worth bringing it up again. Look, I'm a business owner. I'm not here to do the finances because I'm passionate about my widgets, right? At what point do I need to bring in a financial person? Is it a contract person? Do I have a full-time? Do I call them a bookkeeper? Are they a controller? Are they CFO? At what point do we begin to do all that? Is there a magic number? Is there a magic size? What does that look like?
Yeah, I don't know that there's a magic number. I would say as you start to build your company, if you're using QuickBooks, it's going to pull the data from your checking account and whatever accounts you tie into it. So that's going to really be able to track your revenues and your expenses. You do need somebody to go in and make sure they close out the month, where they go in and compare the bank statements to the QuickBooks and make sure that they tie those together. They reconcile the account. And then I would say once you start to reach, probably, close to, depending on what your costs are, but I would say probably bringing somebody in-house to get a better look at it. When you start to hit, $100,000 a month, you need somebody probably part-time. But again, depending on how many transactions, because some people got to sell 1 million products to get to that number. Some people got to sell 2. So again, depending on the complexity of your business, but I think as you start to get, it's just when you start to bring somebody in that's watching, helping you manage the accounts and the accounting side of it, you're going to see that person pays for themselves really quick, because now they're watching your accounts receivable, they're lining up your accounts payable, they're looking at some of the trends, they're looking at your cost of goods sold. Are your costs going up? Are you adjusting your price fast enough to match the rising cost? You just gave somebody a raise. That means your cost of delivering a product just increased, but did you increase your product cost or your product charge, your revenues to match that? If you didn't, I like to always say this with the business owner, that money comes right out of your back pocket. And I drive that home to them. That money, that comes right out of your back pocket. Oh, that money you saved, that goes right to your back pocket. and start to change their mindset of way they're looking at their financials. But I think it truly is. I would recommend always starting with an outside firm. Probably once you get to the 10 million mark, is you would bring some internal, more of a controller type person. But there's a lot of services that will give you that fractional, CFO.
I
But
feel like
as you're
it's very
starting
popular
out,
right now.
yeah, I want to add that to that point. As you're starting out in business, one of the things that we find a lot is that business owners or entrepreneurs typically have someone that they know, usually a family or friend, that's doing their books. That's a huge, huge blind spot for them.
Or they're doing it themselves because they don't trust anybody else, but they're not financial person.
That's
Yeah.
exactly
So,
right.
Here's my perspective on it. You bring somebody in the moment you realize you suck at it.
Which may be day one for some
Day
people,
one,
right?
I guarantee you. Because we avoid the things
Not
we
wrong.
don't like. And if we don't like it, then we just run off our bank account and we're playing this game of like, yeah, but I have money in the bank.
That's
and now we're lying to
exactly
ourselves
right,
versus
Ricky.
just saying, hey, right? You can go find the fractional organizations or entities and just by, hey, you have few charges, maybe find somebody who can work with you based on the amount of transactions you have. You grow a little bigger, you stair step. Like there's different entities and ways to grow. But if you don't like it, don't pretend that you're going to be amazing at it. And the amount of time it's going to take you to learn this versus outsource it, you can absolutely multiply your revenue and profitability because you go do the things you're great at, not the things you're not so good at.
Yeah.
Free up your time.
Exactly.
And at the same time, creating more efficient, effective systems financially, which is also going to save money as well. So it's kind of a win-win on both sides,
Absolutely.
right? That bookkeeper or whatever pays for itself, and at the same time, frees you up to go bring in more revenue.
It's
right?
the whatever that we're always scared of, and that we you said bookkeeper or whatever. It's the whatever that's running your book.
Hey, my mom's doing the books. It's fine. So, yeah.
It usually is a relative of some kind.
Yeah. All right. Well, one last question here. We've talked about blind spots recently. A handful of episodes we were talking about blind spots, and one of the themes that came up there was finance is a huge blind spot. So let's be a little bit more specific here. What are and I want you to really delve in a little bit deeper here. What are some common budgeting blind spots that leaders and owners and department heads need to be aware of?
Poor forecasting.
Poor forecasting.
Yeah.
Right. We talked a little bit about that already. Like, are we forecasting our expenses and revenue?
Yeah.
Yeah.
And I would say insights are untimely or not accurate, right? But I would say that we have a rule here. For any of our clients, you need to have your P&L and balance sheet run by the 10th of the month, no later than the 15th, and you need to have it reviewed, like a monthly for the last month, for the previous month. So now we're here in November, all right, come November 10th, November 15th, we're going to have our P&L and balance sheet for October. We're going to sit down and we have it on the books. I absolutely love Patrick for this because it's like and it's like mandatory. This is the team budget meeting. Let's go. Nothing comes over it, right? It's that important. And when we created that rhythm of meetings, it allows us to measure, allows us to analyze quickly. And what happens, a lot of people are like, oh, I have it. And they say, yeah, I can have it. It's I have QuickBooks. Great. Or they can run the report, but then they put it in the top drawer, right? It's running it.
It's a spreadsheet, not a communication tool, right?
Right.
Yeah.
Yeah, and truly use it as a team building tool, not an accounting exercise. And really look at, when you're comparing your budget to your actual versus last year, you'll start to see some trends that can help you to make some adjustments in your business. And that's the other thing, like when we talk about those financials, if let's just say you're getting it at the end of the month, by the time you review it and make a change,
You're behind the 8 ball.
well, you're already a month behind.
Yeah.
So then it's going to take you a month and then you're not going to know if those changes you made a difference for another month. So you're truly,
Chasing
you're
your
just
tail.
missing the opportunity to run an efficient business and become more profitable and make the adjustments at the time that's needed so that you're staying in business.
I'm going to add one more because I've seen this quite a bit, is the processes you have in place for accounts receivable. When you're billing for stuff, and how intentional are you about making sure those bills are being paid timely by your vendors or whoever? Because I found that numerous businesses that so many of their bills went 60, 90 days, 120 days overdue. And that's not really good finances,
No,
period,
not at
right? You know,
all.
I mean, you've got outstanding revenue that's sitting there that needs to be paid that could be invested back into the business, but because they haven't paid it yet and they're 120 days overdue, that's crazy talk, right? But I've seen business. I don't know if you
Oh,
guys seen that. I've
absolutely.
seen
Oh, yeah.
that. That's like,
Because all it takes is one employee to go and cash their check and ruin it for everyone.
but being systematic about going after those bills and making sure you're on them. It's like, oh, I'm sure they'll pay us in 30 days.
Yeah, right.
And then we come back to 60 days.
So
like,
if you're
oh,
listening
yeah,
to this and
another.
you're just in the business of giving out no interest loans. That's just all.
Yeah, that's what it is. That's what it is. So I love that. So, well, so many directions that we can go here, guys, on the budgeting piece. I really appreciate you guys sharing your insight on this. And again, budgeting is a huge issue. It's a huge blind spot that we keep naming over and over and over again. So that's why we felt a need to kind of come back to this. So certainly I want to say, if you have further questions for us, you want us to address around budgeting or any of the topics of our podcast, please let us know. Reach out to us. Go to 3-peak.com. Go to the contact page and find out more to connect with any one of us. You know, let us know, you know, what do you want more of a deep dive on? We'd be happy to kind of delve into that a little bit more. But we've got lots more content to cover as we keep providing value to you and your business to help you achieve success faster. So, gentlemen, thank you again for coming back and doing another episode here and delving into maybe not the most exciting of topics, but a really important one, right? So we're making it happen. So, Kevin, Patrick, Ricky, thank you again for all that you're doing. Check us out, 3-peak.com. Follow, subscribe, share the podcast with folks. We want to add more value to more people, and we can really use your help with that. With that said, gentlemen, thanks again, and we'll see you at the next episode. Take care.
All right.